Hello, I'm Monica Gibson, and today I'm joined down the line by Peter Dixon, economist with Commerzbank, for a roundup of the UK economy in light of a plethora of empirical data released yesterday and a Bank of England's MPC meeting minute earlier today. So Peter, consumer price growth remained at 2.7% in November. Some analysts have said that what the economy needs to lift it out of its torpor is a period where earnings and house prices rise faster than consumer prices. Would you agree with this sentiment?
Certainly, I would agree with it to a large extent. I mean, basically, what these people are saying is that we need faster real income growth, which, of course, is true because that will help to stimulate spending. And if you look back at what's happened over the course of the last couple of years, it's been the case that higher inflation has taken the edge off income growth. We've ended up with flat to negative real incomes, and of course we can see the damage that has done to consumer spending. So in order to encourage consumers to spend a bit more, yes, a little bit of faster real income growth would definitely be a good thing. In terms of house prices, well, I think the problem is that the market already looks to be fairly expensive if you look at the house price to average income multiple, and I think that encouraging faster house price growth at a time when the market is already fairly expensive, I think would make it even more unaffordable for those people who are currently locked out of the market. So faster income growth would be nice. Faster house price growth, I'm less convinced.
Policymakers said the UK economy would remain stagnant in 2013 and faces further risk from higher food and utility prices. But what would you say are the biggest economic challenges ahead for the UK?
I think there are very many. I mean, obviously, challenge number one is to generate growth, and the problem, of course, is that we're undergoing a period of deleveraging in the UK, as indeed we are in a number of other industrialised economies. So getting households perhaps to borrow more, I think, is a challenge which banks and I think the Bank of England in particular, that's the challenge that they're trying to overcome. And obviously the other issue which the UK faces, which is something which is way outside of its control, is what happens in the Eurozone, because there's no doubt that with the Eurozone being the UK's biggest single export market, problems there are going to weigh on export demand, and we've seen that in the course of 2012. So that's an exogenous risk factor which the UK will have to deal with. And then, of course, the government itself faces the tricky challenge of how to ensure some improvement in public finances without, on the one hand, killing the economy by tightening fiscal policy too much, but on the other hand, also placating the ratings agencies, which are threatening to strip the UK of its AAA credit rating in 2013. So I think there are a number of challenges on the fiscal front as well.
The statement continued that the drag from fiscal consolidation and rebalancing in the periphery was likely to continue into the medium term. However, the minutes also showed an 8-to-1 split on further QE. Given that the Bank of England has so far spent £375 billion buying gilt in an attempt to boost the UK economy, do you agree that no action is the best action at this moment in time?
Yeah, I mean, I think so far as the QE policy is concerned, I think it's fair to say that the bank has given it every shot since March 2009, and as you pointed out, they spent $375 billion worth on this particular program. And the question you have to ask is, what do we have to show for it? Well, perhaps a little bit higher inflation, stronger asset markets, particularly in the fixed income market where the gilt yields were at all-time lows. But in terms of the impact which this liquidity has had on the wider economy, I think it's fair to say it's been very limited. Households continue to run down their debt levels. They're not spending anymore. So this extra income which is being provided by the Bank of England, or extra liquidity being provided by the Bank of England, isn't finding its way to the end consumer. So in that sense, maybe quantitative easing is no longer the optimal strategy, and it's quite obvious that the Bank of England thinks that's the case. So having decided for the last couple of months to leave the policy on hold, I think that's exactly the right thing to do. And if it were me, I certainly wouldn't be looking to extend the policy as we head into 2013.
The strong pound is holding back the UK economy, according to the Bank of England, in what some consider to be its starkest warning yet on Britain's diminishing export prospects. Do you think this raises a question as to why they maintained benchmark interest rates at 0.5%?
Well, I mean, I think that may well be part of it. I mean, what the bank said was, if you look at the real exchange rate, it's true that on various measures of the real exchange rate, the competitiveness gains that were achieved in 2008 have largely been lost. But I think we're faced with a situation now where it almost doesn't matter what happens to the exchange rate. The simple fact of the matter is the demand in the UK's major export market remains sluggish, and that is what is actually holding back exports. And I think as a consequence, the Bank of England is holding down the interest rate simply in a bid to try and give the domestic economy time to fill the gap which this sluggish export demand is leaving. And unfortunately, I don't see any real change to this position over the course of the coming quarters. I rather think it's going to be a case of grinding slowly forward. The bank will keep its foot to the floor as best it can, but I don't think we should expect the economy to suddenly accelerate forward at a rapid pace anytime soon.
With that in mind, what are your projections for the pound in the mid to long term?
On a trade-weighted basis, I mean, we've got something like a 4% appreciation of the pound penciled in over the course of the next 12 months. Certainly in terms of the key cross rate, I think for the UK, which is euro sterling, we're looking for it to fall from somewhere just above 80 at the moment to about 77 in the course of the next 12 months. So a modest appreciation of sterling going forward. I don't think this is going to be a significant impact. It's going to have a significant impact on the UK economy. I don't think it's going to impact upon the Bank of England's thinking too much. But I think you have to look around the risk factors to this view as well. And obviously, the question which I think many people in the FX market are asking themselves now is, well, if the UK were to lose its AAA credit rating in the course of next year, does that make the pound any more or less attractive? And I think it would suggest that there are certainly downside risks to sterling as a result of that issue. So whilst we do look for a modest appreciation, I think we have to bear in mind that maybe that factors may intervene which prevent it from trending as we anticipate.
Peter, thank you for your analysis. It's been great speaking to you. Well, we've reached the midway point of the trading week, but there's still plenty more to come from the Dukascopy TV team, so please do keep clicking back. Bye for now.